Warren Buffett's investment advice is timeless. I have lost track of the number of investing mistakes I have made over the years, but almost all of them fall into one of the 5 buckets of investment tips given by Warren Buffett. By keeping Buffett's investment advice in mind, investors can sidestep some of the common traps that damage returns and jeopardize their financial goals. After much deliberation, I settled upon my 5 favorite Warren Buffett investing tips, which I'll tell you one by one. So now let's start with number 1. Invest in what you know and nothing more. Never invest in a business that you cannot understand is a famous say by Warren Buffett. In my view, the far majority of companies operate businesses that are too difficult for me to comfortably understand. I'll be the first one to tell you that I cannot forecast the success of a biotechnology company's drug pipeline, predict the next major fashion trend in teen apparel, or identify the next technological breakthrough that will drive growth in semiconductor chips. These type of complex issues materially affect the earnings generated by many companies in the market, but are arguably unforecastable. When I come across such a business, my response is simple: pass. There are too many fish in the sea to get hung up on studying a company or industry that is just too hard to understand. That is why Warren Buffett has historically avoided investing in the technology sector. If I cannot get a reasonable understanding of how a company makes money and the main drivers that impact its industry within 10 minutes, I move on to the next idea. Second point is also the most important point when I do research for companies to invest in. Never compromise on the business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high quality companies with promising long-term opportunities for continued growth. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, said by Warren Buffett. One of the most important financial ratios that I use to gauge business quality is return on the invested capital. Companies that earn high returns on the capital tied up in their business have the potential to compound their earnings faster than lower returning businesses. As a result, the intrinsic value of these enterprises rises over the time. When you buy a stock, plan to hold it forever. This is the third investment advice from the legend Warren Buffett. If you are not thinking about owning a stock for at least 10 years, then don't even think about owning it for just 10 minutes. Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent businesses that continue to have a bright long-term future. Buffett runs a concentrated portfolio for this reason. Furthermore, quality businesses earn high returns and increase in value over the time. Just like Warren Buffett said, time is the friend of wonderful business. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. Finally, trading activity is the enemy of investment returns. Constantly buying and selling stocks eats away at the returns in the form of taxes and trading commissions. Instead, we are generally better off to buy right and sit tight. Diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. With this being said, our fourth point is diversification, which can be very dangerous. In my view, individual investors gain most of the benefits of diversification when they own between 20 and 60 stocks across a number of different industries. However, many mutual funds own hundreds of stocks in their portfolio. Warren Buffett is the exact opposite. Back in the year 1960, Buffett's largest position was a whopping 35% of his entire portfolio. Simply put, Warren Buffett invests with conviction behind his best ideas and realizes that the market rarely offers up great companies at reasonable prices. On the other end of the spectrum, some investors excessively diversify their portfolios out of fear and ignorance. Owning 100 stocks makes it virtually impossible for an investor to keep tabs on current events impacting their companies. Excessive diversification also means that a portfolio is likely invested in a number of mediocre businesses, diluting the impact from its high quality holdings. Now answer my question. How many stocks do you own? I want you to pause this video right here and go in the comment section below and answer this. If your answer is more than 60, you might seriously consider slimming down your portfolio to focus on your highest quality holdings. The stock market is filled with individuals who know the price of everything but the value of nothing. This is the most important thing to notice before entering into any stock. Know the difference between price and the value. Stock prices are pushed at us non-stop. For some reason, investors love to fixate on ticker codes running across the screen. However, stock prices are inherently more volatile than underlying business fundamentals in most cases. In other words, there can be periods of time in the market where stock prices have zero correlation with the long-term outlook for a company. Many bargains were available during the financial crisis because investors were quick to sell off all companies, regardless of their business quality and long-term earnings potential. Many firms continued to strengthen their competitive advantages during the downturn and emerged from the crisis with even bright futures. In other words, a company's stock price was separated from its underlying business value. As long-term investors, we need to hear Warren Buffett's investment advice to buy quality when it is marked down in the price. Stock prices will swing with investors' emotions, but that doesn't mean a company's future stream of cash flow has changed. While there is always some debate surrounding a company's future earnings stream, the margin of disagreement is usually far lower than the stock's price volatility. Investors need to distinguish between the price and the value, concentrating their efforts on high-quality companies trading at the most reasonable prices today. We often make investment harder than it needs to be. Warren Buffett follows a simple approach rooted in common sense. So these were my favorite advices from Warren Buffett. If you found this video knowledgeable, make sure to like and share this video with your friends and family. Have a nice day.